Welcome on board Mr. Aman Mehta, the director at Torrent Pharma as well. The company had made a latest acquisition of around 2,000 crore rupees in the dermat business, which is Curatio. To understand it better, let's bring on board Aman as well. Aman, hi, good afternoon. Thank you so much for making time and speaking with ET now. First up, let's address the investor concern, which was A, that the acquisition is a tad bit expensive, and the fact that this might be EPS dilutive, at least in the near term. What's your response?
So this is an asset which is in a high growth phase right now, especially at EBITDA level. If we just look at the expected profitability this year of the asset versus last year, while the top line would be growing at about 25%, the EBITDA level growth is expected to be about 35% plus, and that's simply because the operating leverage is playing out from a smaller base. So when you have an asset which is growing EBITDA at that level, the multiples have to be seen in that context rather than from a purely objective context. So that's why we feel that this is more appropriate to look at from a 1 year forward, 2 year forward perspective rather than especially a trailing year perspective, because it's an asset in a build out phase.
Would it be EPS dilutive in the initial years, Aman?
Yes, it would be slightly marginally dilutive, but that was also the case in terms of the Unichem deal, for example, which was our last major deal that was done. And a good part of that is because when acquiring a branded business, the amortization component tends to be a bit on the higher side, and it starts kicking in every year. So since you're paying upfront for an asset which is ramping up gradually. So earnings dilution maybe for 1-2 years is something that is expected.
So it will be earnings dilutive, maybe at least for the initial 1 to 2 years, but you are expecting significant scale up post that. But Aman, even in terms of margin profile, it is quite away from your own margin profile, which is mid 40% if I have it right, whereas this acquisition is close to around 20 to 25% mark. Do you expect it to trend towards 40%, or it will continue to hover in this range only?
So we don't share the exact region-wise breakup for our businesses. The company level margin in Q1 was about 29%, and we expect that over the next couple of years it should inch up gradually from that level. Curatio's business is currently around that level as well, and the trend, if you see the last 2-3 years, it has increased significantly from even a 2-year period ago. And that's simply because the fixed cost base remains the same, but the top line increases and the operating leverage starts playing out. So just directionally speaking, we can share that our India business margin is much higher than our company level margin, where Curatio is currently. And we remain confident that Curatio can reach the India business level margins in a 1-2 year period, because the gross margins of the India business that we have currently and Curatio's gross margins are almost identical.
What does Curatio bring on the table besides, of course, expanding your derma portfolio? Does it expand geographical presence for you? Is there cost reduction? Is there additional distribution network that comes on the table?
It's widening our product portfolio, product basket, and reach in a segment that we don't cover, particularly pediatricians. This is a specialized portfolio in pediatric dermatology where we have practically no presence right now. So while the product basket is something that would be added on to our Torrent existing portfolio, which would be completely new for us, it would also bring on a platform for the OTC sales, which Curatio has started maybe 18 months ago, 24 months ago, with the eventual possibility of ramping up once the RX business is in substantial form, which we expect at least a year, 18 months from now on. So both portfolio widening and potential for OTC in the near future as well.
You've already guided that a large part of this acquisition is going to be funded through debt. But could you help us understand, let's say by the end of the year or through FY23, how the debt profile is likely to change?
So we did mention on the investor call that we would be able to share the exact details post the closing of the deal, which is expected sometime this month. So we would wait for that to happen. But just directionally speaking, I think the deal size of 2,000 crore, where the net of cash, the enterprise value is 1885 crores, about 75% of that should be debt funded. And we expect that in a 2-year period, our overall company level debt should come down to about 2,500 crores.
We let you go. If you can quickly help us understand what's the update with respect to the inspection at the Dahej facility. That is something the analysts want to know a bit more about. Could you clarify?
So while the Indrad inspection did happen recently, we don't have visibility on the Dahej yet, but we expect that it should be possibly within the next couple of months, given that the US FDA inspections have been on the rise in India. So hopefully in the next couple of months, the Dahej should be up for inspection as well.
On that note, we'll let you go, Aman. Thank you so much for joining us with that update on the acquisition plus how the overall business is really performing.